Welcome to the WA Property Q&A, the podcast where I explore the ins and outs of buying property in Western Australia. I'm your host, Peter Fletcher, and each week I interview local property experts to help you to develop a deep understanding of the nuances of buying property in WA. From market trends to legal considerations, no topic is off limits. But before we dive in, a friendly reminder. While we provide valuable information, it's important to note that nothing discussed in this podcast should be construed as personal investment advice. Always remember to seek the appropriate professional advice for your specific circumstances. Now, let's get started and unlock the secrets to successful property buying in WA. Right. Welcome to another episode of the WA Property Q&A podcast. And with me, I've got a couple of legends of their respective industries. On the one hand, I have Franca Jankowski, leading senior conveyancer, licensed conveyancer, been a conveyancer in multiple countries, and is just the guru when it comes to conveyancing. And also with me is Andy Lowe. Andy is a finance broker with Aussie Home in Vic Park, and just an absolute top broker, does a lot of business, and the business you do, Andy, is just top shelf, top quality, and we love working with you and your clients. So welcome to the show, guys.
Pleasure's all mine. Thank you, Peter.
So today we kind of want to answer the question, what are the grants available to first home owners or first home buyers? Are we seeing plenty of first home buyers out there at the moment? What's your feel on the ground?
There is. There's certainly a lot of demands out there that people just really want to get out of the rental trap. And the good thing is, like, interest rate there hasn't been many movement over the last 6-7 months. So that's a positive sign for a lot of people out there on the market. But the market is really, really competitive. Very competitive.
It is competitive.
Very.
So you're getting clients who are wanting to transact, but they just can't because they can't get their offer accepted?
That is true. But just to add on that, it's more that they need to sacrifice or compromise on a lot of areas in terms of the price point, in terms of, say, some people may have it's really numbers driven. They're really sort of very focused on the budgetings. Say, for example, they don't want to spend more than like half of their pay on a mortgage repayment, but then that would kind of limit or lower the price point.
Yeah.
The property they can afford.
Yep. So
it changes dynamically.
Yeah. Yes. I took a client through a property. I shared the photo with Franca and the team in Cloverdale last night. Would have been 100 people there, and there was a queue literally from the front door to the verge.
Wow.
And there was people still in their cars. Like the street was just chocker full of cars. And
it's the same as my property, 2 houses from me. When I went to the open house, I had the same issue. My whole street was blocked full of cars, and it was just a wave of people in and out.
Yeah.
In a small time frame too, because the open home is only 30 minutes, and inundated.
Mm-hmm.
Yeah. It's crazy.
Yeah.
And what ends up happening is the property is advertised that buyers over $499, which you know that it's never going to be that. It's going to be $550 to $600 as a minimum.
Yep.
Don't be surprised if it goes $620 or plus.
Mm-hmm.
And you're suddenly having a conversation with your client and that is legitimately what I said to the client. You might want to go back and talk to your broker and see what you can do with your budget, because the last thing you want to do is make too many of those compromises that you just mentioned.
Mm-hmm.
Because, like, literally, that house was pretty ordinary.
Exactly.
But that's the situation right now, unfortunately.
All right, so these people, they want to get on the first rung of the ladder. What are the grants available to them?
Right, okay. I guess I will start first. So basically, First home on grant is the usually the first thing that pops up in people's mind when it comes to buying first home. However, being how competitive the market is right now in Western Australia, I would say it really needs a revisit because the threshold, it's unreasonably low comparing to the current market. Now, as it stands right now, is if you buy a property, established property, below $430,000.
Oh, it's gone up.
Oh,
It's just gone up
Just
with
9th,
the budget.
9th of May with the budget.
oh, okay. Right, sorry, I'm outdated.
No, but you're right. It's gone up so...
But it's not enough.
No.
Not
It's
enough.
not enough.
Only 450 is still ridiculously low.
Yeah. So it's now 450
Mm-hmm.
to 600, as opposed to what it used to be is 430 to 530.
Yeah.
And just about they announced the 450 to 600, and you're straight away going, it's still nowhere near enough. Like it's just about impossible to buy a home less than 600 now.
Yeah, unless you're buying a unit or an apartment of some sort in an older area. This is not even a new apartment or a townhouse. You're still looking at over 600 easy.
Oh, yeah.
You know, for maybe a one bedroom.
Yeah.
So, yeah, ridiculous.
Yeah. So the first homeowner grant, that's available to, is it just new builds, isn't it? Or
Not necessarily.
The grant itself?
The grant itself, if you want to claim that rebate, yes, it's only for new build, house and land packages, where if you buy established property, you generally only eligible for the stamp duty discount or concession.
Yeah. So up to 450, it's no
stamp duty
No
at
stamp
all.
duty. That's a big saving.
I could say if you were not a first home buyer buying 450, the stamp duty would be about 15 grand, give or take.
Big
So
saving.
that it's a 15k savings for first home buyers.
That pays your LMI.
It will. In saying that, as a first home buyer, there are some incentive from the government that would help first home buyers avoid paying the lender's mortgage insurance when they have less than 20% deposit. Now, this scheme is called first home buyer. It's a government guarantee scheme. Basically, is if you, as a first home buyer, you're able to contribute as little as 5% deposit, and if you're single and you earn less than $125,000 a year, or a couple, or de facto or married couple, you earn household income combined less than 200 grand a year, you would be eligible under the government scheme to buy a property with as little as 5% deposit, pay no lender's mortgage insurance, would be eligible for competitive interest rate from a lot of mainstream lenders, and you are able to buy a property up to $600,000. Can be new build or can be established house.
That is a massive saving for a first home buyer.
Correct. That could be, say, assuming that you max out everything, buying for $600,000, contribute just to 5%. Lender's mortgage insurance generally would cost at least 25 to 28 grand, depending on the lenders.
Wow.
So that there, it's a big savings. Big savings here.
That is a massive saving. But it has to be less than 600K,
Correct, yes.
and they, as a single person, earning less than
$125,000.
125,000
a year. Correct, yes. Which is achievable. On the current market, $600,000 will still be able to get you a decent house and 125 grand a year, you still be able to afford the mortgage repayment quite comfortably.
The 125,000, how is that calculated?
Right, that's a really good question. Now, the condition is your most recent financial year tax return, your taxable income must be less than your threshold, which is 125,000 for a single person. Say, right now, we're 2024. This year, you're on track to be earning maybe 150 grand or 180 grand, for example. But then your previous financial year, your tax return shows that you have only earned like 125 grand. Then you technically are still eligible up until the end of this financial year.
Right, so you need to buy now.
Correct,
before
yes.
End of,
You need to jump on the bandwagon.
Buy now, yeah.
So is it their taxable income or is it their gross income?
Good
Which
question.
is
Different.
yeah.
It is a taxable income on your notice of assessment.
Right.
That
So
determines your
So
eligibility.
if a tradie had a gross income of 150, and they said, well, we're going to, coming up to the 30th of June, we're going to dump 20 grand into tools, and we're going to dump 15 grand into superannuation to pull our taxable income down to under 125,000. I don't think my sums were just quite right, but ignore that. That would be a possibility.
Possible. Possible.
Mm.
Possible. The numbers on the notice of assessment is
Yes.
the key.
Yes. Mm.
Yes, and that's the most critical number to determine the eligibility.
So there might be a temptation for someone to go, well, I'm just going to make a massive tax deduction claim.
Yes,
sure
but
no
it
one
is
would do that.
Sorry, I just
You just now giving it
it is a really, really good question. I would say.
financials.
But then it is sort of like a double-edged sword, because if you do that, yes, you might tick the box to be eligible for the 5% deposit government scheme, but when it comes to your borrowing capacity assessment, that would kind of hurt you, because if you write off a lot of expenses against your business, your borrowing capacity is calculated based on your profit, not the gross revenue or the sales. So you might say that is a very, very common misconception amongst a lot of sole traders or business owners, that they may think the revenue is the income that they can borrow money from a bank. Well, it's half true. There are solutions for that, but unfortunately, that would not be a eligible income assessment method under the 5% government scheme. So, just to keep it simple, 125 grand.
Yeah.
That's the magic.
That's the magic number. Okay. Are you seeing many people use this?
Yes, a lot of people.
Right.
A lot of people. It's because a lot of people, they don't really have a privilege of, living with the parents just to build up the savings like relatively quickly. So, on average, if you keep on renting, $500 a week, a year is 26 grand. So if they are able to save that 26 grand to build up their savings while living at home, happy days for everyone. But a lot of people,
Franca knows some people.
Totally.
a lot of people, they don't have that privilege, right? Yes. So they're renting a little unit, and then working and then pay all the bills, and they still need to build up at least a 5% deposit. So that it's a really, really tough.
It is tough.
Simon.
It is tough, isn't it? I was watching, it was probably a TikTok or Insta, to be honest, and it was how long does it take to save a deposit in the different capital cities? And if you're earning, let's say, 80 grand a year, let's say as a barista in Sydney, you're going to be saving a long time because rents are higher, prices are higher. It's just harder to get on the first rung of the ladder. So no wonder people are taking these opportunities.
What about the super scheme, where
Right.
he's putting into the super to be able to access that?
Okay, that one, that is, again, only available for first-home buyers. And it is an arrangement between your employer, ATO, and your superannuation fund provider. Now, you need to voluntarily or deliberately make salary sacrifice into this first home super saver scheme. Without doing that, you can't just take the money out of your super directly to use it as a deposit to buy your first home. So you need to first make the arrangement, deliberately sacrifice your salary up to a certain amount, and then each financial year, each individual can only draw up to 15K out of that super saver scheme. And 15K, you can consider that as a saving plan, I guess. That is the best to sort of force yourself to save up a bit of money every year without feeling the real pain of compromising your disposable income, I guess.
That reduces your
will.
tax bracket, though.
It
too,
will,
right, if
it
you're
will,
doing that,
yes,
yeah.
because you are sacrificing your pre-tax income into that scheme. So you're paying less tax, but then in pocket, you would really need to be a very numbers-driven person to manage your budget in order to get comfortable sacrificing the salary.
So somebody I know very well recently sacrificed 15 grand into their super using this scheme. So they got taxed going into the super fund, 15%. That's standard. They did get a tax deduction of the 15,000. So they're going to get that back in their tax. But when it came back out to them, because this guy was earning so much, he got pinged for like at a not a marginal tax rate. It's a special tax rate anyway, and basically it was not worth doing.
Okay.
Yeah, it was.
Ask you, yeah.
Yeah,
No.
it was.
For the exercise, no.
Oh, it will be in the end, because by the time it washes through this tax system and then he does his tax return this year and then he gets his tax back, yes, it will be. But in the short term, it actually didn't look as anywhere near as attractive as we thought it was going to, because he got dinged for this extra tax.
Is that because he was a high earner? So if it was somebody that was maybe not in that wage scale,
Yes.
it might work a bit more advantageous. Yeah.
Yeah. It was. Oh, I can never remember what this. It's a special tax they charge. I can't remember. Anyway.
Main tax. Income tax.
Yeah.
So a lot of first-time buyers that use that scheme, or is that
Not
is it
many.
common?
Not
No.
many. Not many.
It sounds like a bit of a hassle.
It is.
Setting up
And
everything there.
just, I guess, it takes a bit of work for a very minimum benefit. So a lot of people would probably just don't bother jump through all the hoops, speak with the ATO, speak with the employer to actually do that.
I'm a massive fan of the program. I think that if you look at it in total, like you're getting this tax deduction on the full 15 grand, and you're only paying 15% tax going in. So you're in front. The government's helping you do this. But the implementation of it is not ideal. It's not perfect. And I get what you're saying.
It needs to be a bit more, a lot more streamlined to make it easier for people to operate that. And especially when they are in a situation that they want to stop paying rent, get their first home, they should really make it easier for them.
Are you seeing any with the budgets, new budgets coming in, and they're proposing these tax cuts to everybody? Will that help first-time buyers now?
That's a really good question. Some banks has already made changes to their calculations to reflect that, but at this stage, it's still a bit too early to sort of say whether or not it's a good idea when it comes to residential lending, because it doesn't really. I haven't really seen enough data that this tax cut would actually help people to borrow more money on the same level of income just yet. But in saying that, it's hopeful. It's hopeful. And a lot of, and coming up to end of financial year, a lot of the bank will sort of review the calculations again. So hopefully, that would improve borrowing capacity to a lot of people, so that that will be helpful for them to get into the property market sooner rather than later.
Start seeing some interest rate drops. There might
Correct.
be
That would be the most helpful.
Yeah, so after looking at that home open last night, I just wonder whether we need interest rate cuts. Like, this market is already at unhealthy levels of demand. It is just nuts. And I'm seeing people paying some pretty crazy numbers.
So you mentioned when you had a previous interviewer that you were talking to that our current market at the moment is still actually not at the level it was back in like 2004, where we're on projection for maybe a 24% increase in properties. But if you look back 20 years, 20 years ago, it was about 40% increase. And then what happened? So,
Yeah, and then what happened is we had a GFC is what happened. It's a lot of this exuberance, it can come to an end. Well, I don't think it will. I think it'll slow down rather than come to an end, but it's, wow. I think this is worse than what we saw in 2004, 2005. Yes, the growth in property prices might not be the same, but certainly the market feels stronger than it was back then. Yeah.
A lot of more populations coming in.
It's just crazy.
The growth.
It is legitimately crazy.
Yeah.
Now, back to grants. We've covered first home buyer grant. We've covered the
government guarantee.
We've covered the concessions, stamp duty concession. There's another one.
The super saver scheme.
We've done that.
Yep. And there's another one for the 2,500.
Which is the home buyer assistance account.
Home buyer assistance. This is the one that gets people back on their feet.
That hasn't changed though. That threshold is still the same.
$400,000.
Yeah, still 400,000. So they didn't actually, because it's a completely different scheme, not governed by the government. Nothing's even been looked at that, which is something that maybe would be helpful.
Yes.
First time buyers, if they put that in line with what's happening now with the thresholds.
Yes. And just to build on that though, that one, there are some unique eligibility criteria that the first home buyers needs to meet, which is the property must be buying through a licensed real estate agent, and it must be through borrowing money from a bank. It cannot be a cash purchase, and it cannot be a purchase between relatives. It must be through a licensed real estate agent in order to claim up to about $2,000 to sort of cover some of the settlement costs, like building and pest inspection, settlement fees. So, yeah, something's better than nothing. That'd help.
But getting a property less than 400,000 is just like...
In the current market, it's...
Well done to the government for working out how not to pay these
But
sort
they're
of
making more
grants
money in
out.
stamp duty. So, where's that coming back?
Yeah.
Now, I think we've covered grants pretty well. On that, the subject of stamp duty, and this is a question without notice to either of you, are we better off with a land tax or a big lumpy stamp duty? Wow, I've absolutely stumped them both.
I mean, I guess it depends on how they structure it, because obviously that'll be like an annual cost that they'll have. And if it would work out the same as what a stamp duty would be if they were to pay that in one sum, and they can break it out into land tax payments for everybody, then it could work out better because it'll be absorbed into their annual rates that they pay, where they're having to fork it up front. Because a lot of people struggle to make that stamp duty payment with their initial deposits. It's hard, and with adding it to their finances and so forth.
So I think I paid, I don't know, something like $6,000 in stamp duty back when we bought our place. I think it would have been about that number. Wasn't a lot. Wasn't a big purchase. It was a long time ago, and like I'd prefer to pay that $6,000 or $8,000, get it out of the road, get it up front, and then sit there rent free for the next 30-something years.
I guess it comes down to the individual's situation. Like, for example, it's a bit like insurance, like car insurance. If you pay, or even registration, if you pay the full year up front, usually is cheaper than you pay it monthly. Usually there's a loading on it.
Okay.
You could get it like, if you had a choice to say you want to defer it or pay it up front, and then that gives the individual that scope of being able to do what they, can do financially at the time of their purchase. We see that with Underground Power. Underground Power, they give the ratepayers a choice to pay it up front, or it's absorbed into their annual rates for the next 10 years or so. So similar concept. I think with the land rates, it stays with the owner. That's the thing, is that you'd have to be paid out. Like, say, if they sold the property and there was that added amount, that would then have to be paid out at settlement. So, I don't see a problem with that. I think it could work out well, because stamp duties now are not 8,000 or 9,000. We're looking at anywhere up, 20,000 at minimum. But, if you're going into a $1 million property, which we're seeing a lot more of these, I mean, the thresholds are now increasing to 60 to 70, 80, $100,000 worth of stamp duty, depending on what you're buying. For a $3 million transaction, you're looking at $150,000 to $200,000 stamp duty. Now, if you can try to pay that, if you can pay it out, fine. But if you can't, maybe that's an alternative. Or put on some sort of payment plan. Outside of land tax, maybe a payment plan set up with OSR specifically for stamp duty. With that interest, of course.
I'm sure the government will work out a way.
Admin fee, just a tiny one.
What are the main issues or challenges first homeowners are facing right now to get onto the first rung?
Borrowing capacity.
Borrowing capacity.
Yes. Borrowing capacity.
Right.
That's because cost of living. Banks will review their calculation periodically. And one of the biggest factor for the calculation is what they think a person earning, say, $100,000 income should be spending a month. So that will then determine how much disposable income this person is eligible to borrow money to buy a property. Now, this number, say for example, 100 grand, one person earning 100 grand a year, he or she may think that it's only spending $1,500 a month in expenses, but then the bank think that due to the current cost of living situation, should be 2 or 2.5 grand a month. They will use 2.5 grand to assess this individual situation. So that's one of the sort of hurdle. They're kind of preventing first-time buyer to buy a property that they like to live in. Therefore, they will either need to come up with a little bit more cash to cover the shortfall, the money that they can't borrow from the bank, or just compromise on the price of the area that they like to live in. So all comes to compromises. What sort of compromise that you are comfortable to take to then determine what's the best direction moving forward.
Are the banks still adding 3% to their serviceability?
Yes, that's the most common assessment criteria. There are some situations where they will only apply.
Can you explain that?
Okay. Say, for example, the interest rate that you're paying effectively, the loan that you're signing up, may be at 6%. But then when the bank calculate how much you can borrow, they will add 3% buffer on top of your effective interest rate to calculate how much you can borrow. So, say, for example, you might think you can afford $500 a week in rent. But then when the bank and then you worked out the loan that you think you could afford also equal to $500 a week in repayment, the bank would not simply base on the fact that you can afford $500 in rent and lend you the money on a $500 repayment a week. That's because of that 3% assessment.
So they'll add roughly 30% on top of the repayments to make sure that you can service that.
Correct. Yes, that is just to factor in potential interest rate increases over the next couple of years, any other incidental expenses coming your way to ensure if you can afford a 9% or that additional 3%, then you should have no issue paying up your actual interest rate.
When you're saying that, like you're going off their pay as a gross amount, and you will say $100,000, but that's in reality that's not their take-home pay because the taxes are taken. So is that 3% also cover kind of that, or how do they work out that? Is it that's not what their net earnings would be that they would be living off if you're going off their annual gross income?
That 3% is more to factor in the future variables.
Right.
Where when it comes to their income, the bank will have their own tax calculations. That tax calculation is based off obviously the government budget and all that to calculate how much disposable income that they have at their income level, minus all their expenses based on the bank statements and based on what they've declared, and also what debts they may have, including student loan, HECS debt, which is one of the biggest one, credit cards, personal loan, car loan. So all those areas plus the 3% combines together, it could change the individual situation dynamically to then determine how much they can actually borrow and afford and how much they can afford on a house.
What are the things that a first home buyer could do to improve the amount of funds available to them from the bank?
Okay. Do not apply for credit cards, or avoid. Not that you can't, but you need to know. You need to set a direction what you want to do. If you want to buy a house, then these are the steps that you need to take, which is avoid applying credit cards, even though you think you are able to pay off every credit card bill.
Mm-hmm.
The bank would not care whether you are able to pay up the credit card in full or not. They will simply assume that you will max out your credit card at all times, at any times. So say a $5,000 credit card, they will take a percentage that they think is reasonable off the credit card as your commitment to the card a month.
Mm-hmm.
So it can be 3%, can be 4%. Some banks are even harsher. Regardless, you are able to pay that credit card in full or not every month. So another thing that they need to be aware of is personal loan or car loan. If this individual is a car person, they recently got a pay rise. They want to buy a really nice car. Nothing wrong with that. But then if you take up a big personal loan to get that car that you like, yes, you get the enjoyment out of it. But then when it comes to buying a house and you need the money, borrow the money to buy a property that you like, it could hurt your borrowing capacity substantially.
Mm.
Yeah. Say your income could be eligible to borrow $500,000-$600,000, but because of that particular personal loan that you took up a while ago, your borrowing capacity could be reduced to below $400,000 or even to the mid $300,000 mark. Therefore, the property that you can afford will be substantially inferior comparing to before you took up this personal loan or car loan. Yeah.
Do the big things first.
Correct. Yes.
I do have a question.
Go for it.
So what if a first-home buyer who is not renting, staying at home, has no debt?
Asking for someone.
Asking for someone. Has no debt, has no credit card debt, no car loans.
Is there anyone's name that you want to mention?
Hypothetical. And they've no debt and they're coming in for a loan. How has their credit history been assessed then?
That's a good question. In Australia,
In America, you have to have credit.
Correct.
You have to have so many cards before they even look at you. So that's why I was asking,
Yeah. In Australia, it's less of an issue. Sometimes having no credit history at all could actually be could work in favor sometimes. Ultimately, comes down to how clean your bank statements, the patterns. A lot of the time, the bank will ask for bank statements, 3 months, 6 months, depending on the situation. They will, if they pick up certain expenses that's a bit out of the box, they will ask questions. If they picked up certain regular payments, they will ask whether or not it's a debt or personal debt or a non credit critical or non-regulated debt that is your commitment. So to answer your question, it's not the end of the world if you have zero to minimal credit history before applying for a home loan. And just to build on that a little bit, first-home buyers are living at home. They could actually first buy an investment property as the first ever property, not living in it, keep staying at home, keep your maybe more savings. At the same time, this investment property, they will have renters living in it to sort of repay their mortgage. They can just enjoy the capital growth from the equity. And when they are ready to move out of home, they will have less of a dramas, less of a hurdle when it comes to the deposit because the equity is there for them to access.
And they can still qualify for first home owners?
Yeah, as long as they don't move in to this property.
Yep. So, win-win.
Win-win. It sounds like you're never going to get rid of that. The person that we haven't mentioned their name of.
But, Europeans.
Oh my God.
That buying investment property as the first ever property, it could disqualify them from some government incentive for first-home buyers, but the big one for which is the first home on the grant,
And stamp duty concession.
and the stamp duty concession, they are able to retain that
Yeah.
as long as they don't
In
live
this
in it.
market, though, they probably could do that in a year, couldn't they, with the equity?
Oh, yeah,
So
100%.
Be home very long.
All you'd have to do as a kid, you just go out, put your name on a title. In 12 months' time, you'll be 100 grand richer. Full stop. End of story. The way the market's going.
Yeah.
In fact, it might not even be 12 months.
So maybe that's kind of maybe where we should be, you know,
Channeling.
handling it. More investors.
Capitalize on
More investors.
We should do an episode on how to get rid of your adult kids out of home.
There's probably a lot of us out there
Uh,
in the same situation. I mean, we have kids that are struggling because the market's moving a lot quicker than they can save up their deposit for.
Yeah.
So it seems like it's always out of reach. By the time they get to that point where they can do it, it's now impossible because it's gone to a higher level. So I think there's a lot of people in the same situation and with these same struggles at the moment.
It's
And
not just first home
yeah.
buyers. It's someone's gone out, had a relationship,
Yep.
bought a home, split up, don't want to rent, come back home.
Yeah,
plenty of it.
there's lots of stories there. Yeah, sure. It's
Right.
every sector's hurting at the moment.
Is there anything we haven't covered in terms of first home buyers getting their name on the title?
for first home buyers. I guess I will have just one. I guess the biggest takeaway for first home buyers out of this podcast would be be comfortable making compromises.
Mm-hmm. Okay.
And as long as the sooner that you make those compromises with the way that the property market is growing, that capital growth you get would outrates all the compromises that you may have taken.
Is another way of putting that, Andy, don't try and get your first property perfect. Just buy a property. Don't try and get it perfect. Just get on the first rung.
On the back of that too is pre-approvals. They need to go in with a pre-approval at the moment. But we're also seeing that a lot of clients are coming through to us, even first-time buyers that are making cash offers, which are not cash offers, just to be able to get their foot in the door. Because it seems like the first-time buyers are the ones that are missing out at the moment because they're not looking as attractive as the one that's coming across that has no conditions basically on their contracts. So it's kind of pushing people, and I think maybe real estate agents or so are kind of leading them towards doing that so that they can get their offer accepted. So I think from a financial point of view, with your pre-approval, where's the danger lies that these people can get into, especially first-time buyers, by doing something like that?
Well, that's another very good question. Pre-approval seems to be a compulsory document that a lot of people needs to have in order to buy property right now. But then that one that you mentioned, cash offer, going in with cash offer, but then still need finance, is a bit of a risky move. But I guess from a finance expert perspective, I just need to make things happen for the client, for them. Just need to work with the buyer, put together solutions, keep liaising with the selling agent and the seller to make that happen.
The problem there is the pre-approval is still subject to conditions, one of which is valuation. And as a first home buyer, you buy a property and you think this beautiful little home, lovely lawns and gardens, beautiful inside, ticks all the boxes. What I didn't notice, and the real estate agent conveniently didn't mention, is the high voltage, high tension transmission lines that will have an impact on the valuation. And suddenly the valuation the LVR, permitted LVR, next to a high tension transmission line goes from 90% down to
80,
80s.
or even lower.
Yeah. And suddenly you've got this first home buyer with a 60 grand shortfall. How are we going to deal with that?
This is a really tough situation.
And this is just to say, like,
Put a cash
this
offer in.
is what you were saying, Franca, is, you know, like the real estate agents are coaching these people. You want to get it accepted, get rid of your finance clause. And the
rest, yeah.
and the first home buyer, like the real estate agent is just thinking, I just want to get the best offer for the seller. And the first home buyers just wouldn't have a clue. And they go, oh, okay, we'll get rid of that.
Because they've got pre-approval in the background.
And
'cause
they think
they've got
that-
the pre-approval.
Yeah, they think it's fine,
Yeah.
but it's not. It's dangerous.
My way of sort of planting the seed up, it's to plant the seed up front with the applicants. It's yes, peer approval will give you the confidence to that a bank will be able to lend you the money that you need for a property up to a certain purchase price, but it's only the bank assessment on your financial situation only,
Yep.
subject to an acceptable property. to the
Yeah,
bank.
yeah,
That's what I always say.
yeah.
Which I would then, explain further is to certain location, certain postcode, and especially and on that high voltage power lines, I will also explain to them too. So, if that is the case, you need to be prepared to come up with additional cash somewhere in order to proceed with the purchase.
I would say to any client, unless your finances are, you know, like you've got substantial resources behind you and a pre-approval, do not go cash. I would just never recommend that. I would recommend going short on the finance approval date. So, okay, I'm confident we can get this deal done within 7 days. Now, that's a really ridiculously short finance approval. Franca, I'm sure you will attest to that. But I'd prefer to have a crack at 7 days, getting it done in 7 days, than not having the benefit of a
Finance clause.
on there.
Yep, I would agree. I would agree.
Mm.
Just more protections.
Especially with Andy. Andy, you get 2-3 days max. Sometimes we actually get the finance approval before we get the contract in. So that's how he is. You know?
That is
You know,
often mentioned.
He is a legend.
He is a legend.
He does it, but he does it.
Thank you.
I've never had a finance decline from Andy's clients at all. Never. Since
Well, that's
I've been
because we
working
get
with Andy.
the contracts after the finance approval.
True, I know. But
Guys, we need to wrap it up. Franca, if people want to talk to you about conveyancing, how do they get hold of
you
you?
can visit me on resi.com or call me at the office anytime.
Fantastic.
Always available.
And Andy, if people want to do business with you,
Mm-hmm.
what's the best way for them to get hold of you?
Aussie Home Loans Victoria Park. I will be the first person that pops up.
Yes.
Or just look up Aussie Andy. I will be the first one.
Aussie Andy. Wow. Is that true? You rank for Aussie Andy.
Well, I mean, just keep it catchy, I guess.
Jeez. It's like back in the old days, Aussie John.
Yeah.
All right. Well, that's all we've got time for, folks. This has been a fantastic episode.
Thanks, Peter.
Thanks, Peter. Thanks
Franca.
for having me.
Andy, thanks for coming along. And until next week, this has been Peter Fletcher for the WA Property Q&A podcast. And that wraps up another episode of the WA Property Q&A. We hope you found our discussion valuable and gained some valuable insights into the world of property buying in Western Australia. Remember, while we strive to provide useful information, it's crucial to consult with the appropriate professionals before making any investment decisions. Don't forget to tune in next week for another exciting episode where we continue to unravel the mysteries of the WA property market. If you have any questions or topic suggestions, feel free to reach out to us. Until then, happy property hunting, and remember to seek the right advice for your personal circumstances. Thank you for listening.